Hello, everyone. This is the State of the Markets, May 20th, 2025 version. My name is Jonathan Thomas. I'm with Joe Zappia. We're with LVW Advisors. Today is an update from a video that we did on April 8th, 2025. A lot has changed since that time, Joe.
Yeah, that's
Um,
for sure.
Looking at major U.S. index performances for the past year, markets are about flat. Certainly up a lot since April 8th when we did the video. You may recall that April 9th was the day they came out and they did the 90-day pause. And on that day, on April 9th, the market was up about 10%. So it was clearly the best day. And so far, it marked maybe a near-term bottom.
Yeah, I think this chart's kind of great because it really marks the drawdown in April of 25, really in those first 10 days, right? When all of the tariff announcements came out from the Trump administration, markets just completely tanked. I think the S&P at one point was down 21 or 22% midday. The Nasdaq was down almost 30, I think. But we've fully recovered. So one of the things we wanted to just briefly talk about today in this brief video is the whole idea that um, we have so much more information now in the fifth month of the year that we had in January, yet markets are back to where we started the year. And that gives us a lot of options to make changes in the portfolios if needed.
Yeah, definitely. I think what we talked about was don't make drastic changes on April 8th when the markets are down 20%. And really, we came off of two of the worst days, back-to-back days in the market in our lifetimes. And usually that means it's a good time to be buying and not selling. Odds are in your favor that the markets would rebound. And, sure enough, they did. I don't think we expected it to necessarily happen this quickly. But, if you took our advice and you stayed the course, or maybe you rebalanced or you bought more, I think it worked well in your favor. This is a good slide to kind of show that, right? So if you were to have missed the best day, that was April 9th when the market was up about 10%, you would be at that yellow line. So still down about 7% year to date. Had you just stayed the course, you'd be up about 2. And I think if you even rebalanced or you were buying more when the market
Yeah.
was down, you'd be up even more.
Yeah, and I just want to make one really important distinction here. So it's sort of like the difference between tactical and strategic, right? You're in the middle of the game, fourth quarter, second half, ninth inning, whatever the sport is. You're really not focusing on making changes to your coaching staff or who you're going to trade for next season. You're focusing on the plays and the practice and the discipline. I helped author a market correction playbook for our investment committee. It's on our website, and basically it says that doesn't matter how scared you are, if you're bullish or bearish, that when markets draw down fast and quick and the VIX gets elevated, probability is in your favor to be a buyer or holder and not a seller. So we didn't make a long-term position when we went in and bought more for clients. We just simply said we're putting the odds in our favor here to take action. And now that we've sort of come through that period, the game's over. Now, I think the game is over the volatility for now. Now we can take a look at where we are and figure out if we need to make changes. And that's really, again, the theme of the video.
Yeah,
Yeah.
definitely. And
So,
it's been new leadership too, right? Like it hasn't been the Mag 7 that's been pulling the market higher like it has the last couple of years. In fact, the Mag 7 is really underperforming the rest of the S&P 500 and the index in itself. So it's been different leadership. It's been the quality type companies that I think we focus on for client portfolios that have held up well. They haven't gone down as much, and they've recovered just as well.
I think a theme that you'll see across these slides is that it's really only the large cap tech stocks that are doing really poorly so far this year. The rest of the market is up 5% through yesterday. The S&P 500 is up a little bit, and it's still the Mag 7 that's down. In the following slides, you'll see that's the case with U.S. versus non-U.S. sectors, et cetera. So, Jonathan, I'll just dig right into this slide. So these are the
Yeah.
major sectors in the S&P 500. The blue bar is where they are year to date. So industrials are up close to 10, utilities are up 10. But the gold diamond is the drawdown that occurred so far this year. And that was right around April 7th or April 8th, right about when we recorded that last video. Uh, Discretionary down 26, technology down 26, consumer services down 22, even industrials down 17. But you can see that there's still a handful of things that are negative for the year, but markets are really broadening out. Utilities, industrials, staples, financials, all having decent years so far. Not the kind of action you would really see if a recession was imminent, by the way. Uh, but markets are broadening out. It's not just about tech.
Completely agree. And I think what we talked about going into this year when we were doing videos at the end of last year, early this year, we were talking about, what do markets do when there's back-to-back 20% up years? Or even the other chart we were looking at is, the third year of a bull market. And we were looking at the first year of maybe a new president in office. They're generally pretty weak. They weren't maybe as strong as some others. So that's kind of holding up as well.
Yeah. Yep. And this is since 1928. So on average, the market's up 8.2%. This is almost 100 years of information. And so far this year we're up about 1.5 with a lot of volatility so far.
So, I mean, you touched on this already, Joe, but the rest of the world is doing really well. And, I don't know how much of that is because of some of the policies we have in place with tariffs and whatnot, but for the longest time, emerging market stocks, international stocks have had really attractive valuations compared to the US. So maybe that's a big part of this as well. But if you have a diversified portfolio, you're probably doing a lot better than just owning the S&P 500. Certainly, like just the Mag 7 stocks, for example, you see Europe is up over 20%. And, in my lifetime, really, Joe, like certainly in my career, I don't remember a year, where you're seeing this type of shift.
Well, you're
And now
just not old
international
enough.
stocks are
I
finally
remember.
doing better than the US.
Yeah. Yeah, this is why we're global investors. But again, the theme is that other markets, other financial markets are performing actually pretty decent this year. What's unknown is this a short term aberration, or is this the beginning of a longer term trend where non-U.S. stocks begin to perform, better than the U.S. for a more sustained period?
Yeah. I mean, there's good companies all across the world. They're not all just in the US. I mean, while the US has some of the biggest, best companies and we do business overseas everywhere, there's other companies that are domiciled in different countries. And, it's good to have exposure to those, as you can
Yeah.
see so far year to date. So we've probably looked at this chart 100 times in the last 5 years, but this just looks at volatility, intra-year declines on the S&P 500. You see year to date, we're up about 1% with a intra-year drawdown of about 19. And just to remind people, the average intra-year drawdown is about 14% in any given year. So it's been, slightly more than average, but it's not unusual. Like there have been many declines of 10, 20, 30%. The market's always recovered.
Yeah, I have nothing to add here.
So, I mean, we talked a lot about volatility in the VIX in the last video, just because of the huge spike where we saw the VIX touch, I think, 60. And so this gives you a look at some of those previous spikes of when it touched, higher numbers. This is like the Great Recession, the financial crisis during COVID, Silicon Valley Bank, that crisis just a couple of years ago, and then most recently, about a month ago. And just about every time, if you bought when the VIX was really high, forward returns are usually pretty good, and
Yeah, and we've done,
more the
we've
same.
done some studies here, and it's part of our market correction playbook that when volatility spikes to extreme levels, and anything over 50 is considered extreme. There's only been a handful of instances since 1990 that the VIX has gone over 50. And so it's really easy to say, okay, what happened 6 months out? What happened 12 months out after these big volatility spikes? And again, whether you're long-term bullish or bearish doesn't really matter. It's that the probability is in your favor to have positive outcomes. And I think you'll see that in the next slide.
Yeah,
So
right here.
yeah, so this again goes back to 1990. And if you bought when the VIX was above 33 and a half, on average, your forward 6 month return was 12.7%. So on April 8th, the VIX spiked to 60. And I think markets have recovered a full 20% already from that intraday low level. Now, who's to say where we end up, 6 months from that date or even 12 months from that date? But the whole point of this and the whole point of this video is to say that if you're a golfer, we sort of get a mulligan here because markets are back. I would argue the news hasn't gotten much better. It's still a lot of uncertainty out there, but now we can make decisions as if we had all this information ahead of time. And so
Yep.
I think that's really the key. So if we just look at like what's going on with earnings, which earnings drive market returns of the long term, hands down. Earnings are holding up pretty good. The S&P 500, you can see the earnings growth since the year 2000 is like $50 all the way to 250. I think the jury's still out what earnings look like for the rest of the year or next year, but in general, they're actually holding up pretty well. Okay, so earnings trends are decent. And valuations, as marked by PE ratios, are expensive. As of yesterday, the S&P 500 trades at 20, little more than 23 and a half times last year's earnings and about 22 times expected forward year earnings. And that's on the high side. There's only been a couple of times in history, actually, that markets have traded at higher trailing PE ratios. So we can look at what returns were at these different levels to get an idea of maybe an expected baseline return.
Yeah, I think now more than ever, or at least more than recently, it's just really hard to predict what future earnings are going to be. I mean, all of this is looking at earnings over the last 12 months. It's not necessarily looking into the future. There's just a lot of uncertainty over the tariffs and who knows what else. So, it is hard to predict based on where valuations are today, what the market's going to do. But like you said, we can look at history and say, where have valuations been and what were those future returns? And I think this chart, while it's a little bit crowded and confusing, just focus on that yellow dot. And that's where we are today. If you look at the forward PE, and it implies a forward return, a 1 year return of just 2.2%. Not a great measure of future returns, of course, but I mean, this gives you an idea that, when stocks are maybe this expensive, future returns are not as good.
Yeah, the only thing I would add to this chart is there's absolutely no correlation here. I mean, you expect these to have these dots closely packed together to give you some sort of regression, and you'll see that on the next chart. So what this basically
Yeah.
says is that valuations mean nothing in the short term. You've had returns as high as 50% in the forward 1 year period with valuations where they are today, and you've had returns that have been negative 30. So it's really tough to know what's going to happen in the short term because that's driven more by sentiment and short-term news flow. But over the longer term, and you'll see on the next chart,
Yep.
um, valuation, see how these dots tighten up. So now this is talking about 10-year forward returns, and you can see that the lower valuations are when you buy at the beginning of the period, the higher your forward returns are, and these are actual results. So now you can look at this and say if you're at 22 or 23 times earnings, which is sort of, way out on the right there, your returns are somewhere between probably 0 and 4% a year on the S&P 500 looking out over the next decade. Now, a lot can change here, but given the data we have today, I think it's fair to assume that market returns, at least in the US, are probably going to be below average.
Yeah. I mean, this is pretty similar to what we would have said at the end of this past year, beginning of this year. Valuations are high, interest rates are pretty high, although it seems like they're coming down, but it's certainly not cheap markets, at least here in the US.
Yeah, and I
But
want to
I
make one.
think,
Sorry.
yeah,
No,
go
but
ahead.
I was going to make one point just that during the deep sell down when the markets were down like 21, 22%, the S&P actually got to less than 18 times forward earnings. And that took your 10-year expected returns up over 7%. So again, all it takes is a big correction to drive valuations down to the point where you're putting odds in your favor to have a better return. But where we sit today with markets approaching once again near all-time highs and expensive, we think some caution is warranted.
Yeah, absolutely. I mean, we did a video 6 weeks ago and we were talking about, fear and greed, and there was so much extreme fear. And today we're actually back to greed. And so I think, it's that it's let's not get greedy. Now is not the time to be greedy. It's the time to stay disciplined, time to stay diversified. So that's a huge thing. But then it also is now is like that mulligan, like you said, Joe. So it's a good time to revisit your asset allocation. If you were struggling, sleeping at night during what was going on the last 6 weeks, could be a good time to take some risk off the table and rethink your asset allocation. Because we're given a mulligan.
Yeah, and short-term bonds. Now, there's no bond charts in here, but we'd be remiss to not at least mention it. Short-term treasury bonds right now are yielding 4.5%. Expected returns for stocks are just a little bit better than that. You're getting good diversification with short-term fixed income. Cash is obviously still has a pretty attractive yield. And of course, international markets are much cheaper and performing a lot better. So what's impossible to know is what the secondary and tertiary effects are of all of the sort of erratic, trade and tariff negotiation behavior. And so it's difficult to know where we're going from here. But the good news is that we've got other assets that we can use to help protect portfolios, balance portfolios. And because our portfolios are diversified, not only did we weather the storm pretty well, but we think we're pretty well positioned going forward as well.
Perfect. I think that's a good spot to wrap. Thanks for tuning in. Hopefully this was helpful. We look forward to the next video with you guys. And lastly, with the disclosures, this is just for informational purposes only, and it is not meant to be investment advice. Thank you all for listening, and look forward to seeing you next time.
Thanks, Jonathan.